Hi, this is Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Charles Moran and Nathaniel Ekman. Today, we're going to start off with an update on the economy and stock market. We will then recommend our one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website. That's www.valueline.com and our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service, available as a weekly updated printed publication or digitally, is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The survey includes data, charts, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or by calling 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This commentary was prepared by Value Line's economic staff. The Federal Reserve received some positive news on the inflation front. After the February Consumer Price Index, CPI, came in lower than expected, the Labor Department's companion report on producer prices showed an even sharper decline in the pace of price growth at the wholesale level. Of note, the Producer Price Index, PPI, was unchanged last month after climbing 0.4% in January. Likewise, the core PPI, which excludes the energy and food components, was up just 0.2%, coming in below forecasts. The Federal Open Market Committee, FOMC, held the federal funds rates steady at its March monetary policy meeting. Although inflation eased a bit in February, the central bank is not in a rush to cut the benchmark short-term interest rate again. The Fed prefers to take a wait-and-see approach with monetary policy as it assesses the impact of the Trump administration's tariffs on consumer and producer prices and the overall pace of economic growth stateside. The uncertain fiscal policy may be taking a toll on the U.S. consumer sector. Shoppers are worried that the tariffs placed on imports will drive prices higher in the months ahead. On point, the University of Michigan's preliminary consumer sentiment survey plunged to 57.7 this month, down double digits from the February figure and the lowest reading since November of 2022. The Commerce Department reported that retail sales, after falling 1.2% in January, rose just 0.2% last month, which was well below the consensus forecast of 0.6%. If consumer spending were to sputter, the nation's gross domestic product, GDP, would likely suffer. Ongoing concerns about inflation and the strength of the U.S. economy have pushed gold to a record high price. The precious metal climbed above the $3,000 an ounce mark in mid-March. Gold is viewed as a safe haven asset, with demand typically increasing during periods of economic uncertainty, high inflation, or a weaker U.S. dollar. In conclusion, investors are nervous right now as anxiety about tariffs and the strength of the U.S. economy build. Given this backdrop, we recommend that investors focus on the stocks of high-quality companies that have a long history of generating steady profit and cash flow growth. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am currently located. This is the main landing page for subscribers. Under the quick links, click on supplementary reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheet, Value Line continues to review our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, are two metrics that are considered in calculating a stock safety rank, a critical measure of risk. When considering a new stock to invest in, we strongly suggest you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds, as many less talked about stocks are available at much more reasonable prices. Okay, now let's move on to our one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. The current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and speculation on how far Washington will go in its economic policy changes. Many large, well-known stocks have grabbed headlines lately, but we would like to search for other equities with better long-term potential with acceptable risk profiles. First, we're going to look at stocks that have had a total return of at least 10% over the last year. We want to focus on equities with strong momentum. By applying this filter, we trimmed our potential candidates down from 5,700 to 782. The timeless rank is used to predict the relative 6 to 12 month performance of stocks in the value line universe. This format is an easy to understand scale from 1 to 5, with 1 being the best performing issues on a relative basis. Most often, investors will want to avoid stocks marked 4 or 5. We're going to focus on companies that are ranked 2 or better for timeliness. After applying this filter, we are now down to 89 stocks. Next, we're going to focus on safety. We want stocks that are more on the conservative side, so we're going to focus on stocks ranked 1 or 2 for safety. After applying this filter, our list has dwindled to 27 possibilities. Now we want to look at the intermediate term. That is the 18-month investment horizon. For this, we're going to go to the company data section. We're focusing on stocks with 18-month appreciation potential of at least 15%. After conducting this screen, we are now down to 6 selections. Finally, we're going to focus on the projected 3 to 5 year high total return of at least 10%. This screen provides us with stocks that are poised to generate a decent total return over the next 3 to 5 years. Our final list of candidates is down to 4. They include Medtronic, ticker MDT, Progressive, ticker PGR, Hanover Insurance, ticker THG, and T-Mobile USA, ticker TMUS. You can make a strong argument for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of first senior analysts, we prefer and recommend Progressive, ticker PGR. Before I click on Progressive, please note that the screens can be saved and revisited by utilizing the Create Save Screen button at the top. Now let's click on Progressive's last full page report. As you can see in the array of the digital report, Progressive has enjoyed a very good run over the last few years, particularly last year when it earned a whopping $14.07 a share. The company has enjoyed solid rate increases in recent times, thanks to healthy secular trends in the property casualty insurance industry. The company focuses on auto insurance, which has been spared the worst of weather-related catastrophes that have plagued the industry, such as wildfires and hurricanes. While automobile accidents have trended higher following the pandemic, as there have been more drivers on the road, the company has been able to effectively increase prices to compensate for the additional risk. It should be noted that the Trump administration's tariffs might well increase the cost of car insurance, as the expense of some replacement parts could increase. This is a matter that bears watching, though Progressive ought to be able to pass along the higher expenses to its customers. The company boasts a solid balance sheet with only a moderate level of debt, while reserves appear more than adequate to cover anticipated losses. We look for the combined ratio, which is the sum of the loss and expense ratios, to remain below the all-important 100% figure, which implies underlying profitability. While investment income may be pressured somewhat due to reduced bond reinvestment rates, it should rise on a year-over-year basis in both 2025 and 2026, thanks to an increased asset base. While earnings advances might well moderate over the next 2 years, it should be noted that 2024 was a very strong year for the company, as it was firing on all cylinders. Overall, we think that Progressive offers solid fundamentals at the recent valuation, and it is our one stock to buy right now. We will now tackle your questions. Please note that we can't typically answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to our presentation. Now I'll hand it off to Charles and Nathaniel.
Thank you, Alan. I'm Charlie Moran. I'm senior analyst here at Value Line. And one of the first questions we received was regarding the PE ratio. It asked, please discuss the PE ratio in more detail and how it can be useful for investing. The price earnings ratio, PE ratio, or PE, is the most widely used statistic in investing. If you are like most accomplished investors, you will not make a move without knowing the PE ratios of the companies whose stocks are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic terms, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE by dividing a stock's current price by an earnings figure that includes 6 months of the past earnings and 6 months of the projected future earnings. For example, let us say a company's share price is $40 and its earnings per share is $2. Its PE ratio would be 20, or $40 divided by the $2. If the company's earnings were to jump to $2.50 and its price remained at $40, then its PE would be lowered at 16, a more attractive scenario in this case. There's no right or wrong PE ratio. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite is true for companies whose earnings are flat or growing slowly. If you believe that earnings are poised to take off before the market recognizes it and the company is maintaining its current PE ratio, you might want to buy now in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if our analyst projects continuing growth for a company, but its PE ratio is already very high, you may want to wait for a pullback in price before committing funds so you do not pay more than you want based on the total return that you anticipate. You will also find a trailing PE and a 10-year median PE in our data. The trailing PE does not consider future earnings. It divides the stock's previous trading day's closing price by the most recent 12 months of actual earnings. Second question we received was about the target price range. When your strategy is long-term growth, your goal is to buy stocks with potentially above average price appreciation. Our analyst-derived 3 to 5 year target price range is one of your most important tools for identifying these stocks. Target price range is a forecast where Value Line expects the average price of a stock to be in the next 3 to 5 years. The range is based on our analyst's informed estimate of company earnings during this period, multiplied by the analyst's estimated price-earnings ratio for the same period. The difference between a stock's potential high and low prices depends on the stock's safety rank. Expect a stock with a high safety rank to be more stable and therefore to have a narrow band. A stock with a low safety rank is likely to be more erratic and therefore have a wider range. Because the analyst calculates the target price range using an estimate of future earnings based on information available at the time it is calculated, this measure is very subjective. As company performance changes in the future, the target price range will also be altered. I'll now turn it over to Nate for further questions. Nate?
I've got a question here. Someone's asking, I noticed that the dividend payout has varied wildly throughout the past few years. Any insights, please? And now this is a situation where it can be useful to refer to the footnotes. Every value line page has some footnotes that are useful in particular for unusual situations like this. So looking at the dividends quarterly box for Progressive, we see there's a footnote C that we can refer to. And so down at the bottom here, we first see that there's a note that's no longer applicable about a policy the company had through 2019. Obviously, that's not anything that's in the box right now. However, after that, we see a note saying that the company has paid a special dividend intermittently, which is not included in the dividend yield calculation at the top of the page. So if we look in the quarterly box, for example, we see, these large dividends in 2021, and then this one large payout so far this year for the March quarter of 2025. So those are going to be the special dividends that were discussed. Likewise, there's that one in March of 2024. And so that's what that's that variation that you're seeing, and that's not actually included in the yield calculation up here at the top. That's just an extra. And so when you see something anomalous like that, a lot of the time you'll want to refer to the footnotes of the page and see if there's an explanation for you there. I've got another question here. I'm being asked, I know the usual advice is to stand pat during times of market fluctuation, but how can I feel less nervous about these ups and downs? So one of the other services we offer with the Value Line Investment Survey is we actually have an asset allocation model that our subscribers are encouraged to take a look at. And that's located in the selection and opinion section. If you have the digital subscription, you can access that through here. You go to selection and opinion, and then we'll want to scroll down to page 11 on the digital document. And you'll see Value Line's asset allocation model right there. And this is, as you can see, revised, periodically, right? Like the current model was adopted back in February, and you can see that the previous model ran for several months, from August of 2024 through February of this year. And you'll notice that the current model has a fairly heavy weighting in cash. Now, looking at this model, this is a general model, and it's as good as a general model can be. You will likely want to adjust these specific numbers somewhat for your specific situation based on your risk tolerance and also your age. Age is often used, here as a proxy for your investment horizon, since most people are investing with a plan to access that money during retirement. So for example, a younger person like myself, I'm 29, would probably want a slightly more aggressive asset allocation with a heavier weighting towards stocks than what you see here, because I'm better able to absorb that risk since I have more time to bounce back from it, and I want to be able to capitalize on that ability. Whereas if you're planning to access that money very soon, if you're close to retirement, for example, you may want a fairly conservative allocation. But as we can see here, in the most recent revision, the percentage of cash was bumped up 5% and is now quite high at 35%. And the reasoning for that is that while you don't want to pull out of the market during a downturn, one thing to do if you suspect that the market is going to go down, or if you're in the early stages of a downturn, is you may want to keep a slightly higher portion of your portfolio in cash than you otherwise would. And the reason for that is if you have an unexpected expense later, you don't want to be forced to liquidate other investments at the bottom of the cycle, right? So you want to keep a healthy buffer of cash that you can pull from in the event of any expenses, so you don't have to liquidate unexpectedly, and you can instead do it sort of strategically right at the top, right? And so that's just some general advice for how to handle asset allocation in sort of a fluctuating and potentially scary investment environment, is just keep a little bit extra in cash to cover your expenses just in case. You can get very good rates on cash right now, hence, why our model is so heavily weighted towards cash. That's another reason, just because the rates right now are very favorable for that. So that's something you can potentially use to help you there.
Thank you, Nate. This is Alan again. I had a question come in. Very good question. I have to admit, I'm a relative newcomer when it comes to investing in property casualty stocks. Could you please review some of the standard industry terminology? Sure. Let's start from the top. The first thing is net premiums earned, which is an insurance company's top line. It is the proceeds that the company takes in and retains rather than ceding or selling to reinsurers. Net premiums earned can be increased by drawing new business or raising prices on existing policies. In general, the higher the customer retention rate, the more advantageous it is for net premiums earned. Net premiums earned have generally trended higher in recent quarters across the industry, thanks to favorable supply and demand fundamentals, which has led to pricing gains. Another industry term that draws a lot of attention is investment income. Insurers make money on float, which is the premium income taken in minus their immediate expenses. It should also be noted that insurance companies tend to invest the lion's share of their assets in fixed income securities due to their conservative nature and liquidity. Investment income has also trended higher of late due to a higher level of invested assets and increased bond reinvestment rates. With interest rates trending downward in recent months, bond reinvestment yields will likely gradually decrease in the months ahead, but this is a factor that certainly bears watching. The combined ratio is another important factor for PC, property casualty insurers. This is a measure of the loss ratio plus the expense ratio. The loss ratio measures the aggregate dollar amount of claims that an insurer pays out. The expense ratio deals with the administrative and operating costs of an insurer. Both figures are measured against the top line, net premiums earned. A combined ratio of less than 100% implies underwriting profitability, while a reading of greater than 100% implies an underwriting loss. Combined ratios were quite high across the industry last year due to the hurricanes, wildfires, and other catastrophes. While this cut into profits for many, it will likely result in price increases during 2025's policy renewal season, particularly in the geographic regions and product segments that were directly affected. Finally, the reserves on the balance sheet is another important variable when assessing an insurance company. Reserves are in place to cover anticipated losses. If an insurer isn't adequately reserved, they would likely have to take a reserve strengthening charge, which reduces profits. On the other hand, if an insurer feels that it is over-reserved, it can release funds, which would lift the bottom line. Reserve management is an important factor when analyzing an insurer's prospects. Thank you.
All right, I've got a follow-up question here. Where should we park cash, money market or a high-yield savings account? And I'm sorry to give you a bit of a non-answer here, but ultimately where you park your cash is going to depend a bit on your personal situation and also where you can get the best rates. Because, with stocks, right, the sort of calculus that you're making there is risk versus return. With cash, it's, liquidity versus return, basically. How easily can you access this money? And obviously, it's cash. It's going to be more liquid than something that's tied up in, most investments. but there's still, there's still variables. For example, like if you have something in, a high yield versus CDs, for example. And so where exactly you park your cash is going to depend a bit on what your exact needs for accessing that cash are likely to be, excuse me, over the near future. And so you'll need to examine your situation, and you'll need to look at where you can get the best rates that will accommodate that situation, and you need to make a decision accordingly. What you can even potentially do, if you really want to go sort of all out on it, is you can park, you can split your money up and you can park cash in multiple places. So like, okay, I have this in like a slightly less liquid but higher yielding account here. And then I can get that out a bit more slowly if I need it. And then I have some that I can access very easily, but the yield's not as good here, and that can tide me over to get that money there if I need to. And so you can do some fairly complicated arrangements to maximize your yield while still ensuring that you have access to all of the money that you might potentially need. Usually that's not going to be necessary for most people, but if you really want to, get into the nitty-gritty of it.
Thank you, Nate. I don't see any further questions. I thank you all for joining us.